In 2025, I plan on buying as much investment property as I possibly can. Plus, our buyers agency has had an influx of both new clients and returning clients, all wanting us to help them buy the best investment properties possible. Why? Because they can see that property prices are likely to rise and rise steeply in multiple areas around the country. So right now, I'm spending all day, every day, analyzing the country, looking at rental returns and the best places for capital growth. And one thing has recently caught my attention. Despite the fact that property prices are rising in Australia, there are multiple areas that are really struggling right now and other areas that are really risky to invest in. So in this video, I'm going to share with you 10 of these areas that I would avoid and why they are risky. Before I go into these areas, let me share with you the key criteria I'm looking at. Number one, how quickly can you get your property rented? In my opinion, it does not matter how much someone says an area might rise in value. If you can't get your property rented quickly, it's going to add a lot of stress into your life and make everything go fairly pear-shaped. Number two, I'm looking at safe long-term growth in these areas. This is not about speculating. So if you're someone who's trying to maybe get rich quick or looking to speculate and find an area where you can get in at the bottom and get out at the top, you might disagree with what I'm about to share with you. And number three, I'm going to look at the socio-economic status, because the last thing you want is to buy an investment property and then have people trash your property. And if you'd like a full breakdown of how I analyze the best areas to invest in, check out the link in the description below to get free access to my in-depth analysis on the best and worst areas to invest around Australia. The first market that I'd avoid, and this might surprise you, is Darwin. As you can see from this latest data from CoreLogic, Darwin property prices are rising. In fact, in the last 3 months to the end of March, Darwin has been the best performing capital city. So if prices are rising, why would I then say no to Darwin? Simple. When we look at what's happened to property prices over the last 10 years, nothing has really happened. Price growth has been negligible. Population has actually decreased. They've had a net outflow of people. They just don't have the economic diversity. 30% of the income still comes from mining, which is very, very high, and they don't have enough infrastructure projects and diversity in the economy for me to say this is a very safe investment. Now, don't get me wrong, I do expect that property prices will rise in Darwin in the short term. So if you're someone who wants to speculate, buy now and think you can pick the bottom and get out, maybe Darwin's for you. But if you're someone who's looking for low risk, safe investing like I am so you can sleep at night, then Darwin is a market I would recommend avoiding. Then we move on to Victoria in Melbourne, Hawthorn West, located 14.6 kilometers northeast of the Melbourne CBD. Median price, $734,000 for a house, quite affordable relative to, say, Sydney. Vacancy rate 0.89%, so very easy to get your property rented. So then why would I avoid it? Well, 3 reasons. Number one, the ratio of tenants to owner-occupiers is over 50%. So you have a majority of tenants living in this suburb, which is never good for capital growth. You want to be buying in suburbs that have a majority of owner-occupiers. Number two, the socio-economic status of this suburb is very, very low, which would concern me. And this goes to the next point, which is that Hawthorn West has the highest percentage of social housing of all suburbs in Melbourne at 28%. Way too high for me, and that's why it's a suburb I would avoid. Staying in Victoria, the next suburb I would avoid is Meadows in Melbourne, located roughly 35 minutes north of the CBD. Median price for a house, $564,000. Very affordable based on what you can get in other capital cities. So then why would I avoid it? Simply put, it's the low socio-economic status of the suburb that would worry me in terms of the quality of tenants. There's also a significant portion of people who are renting in this suburb versus owner-occupiers. And so although it might be affordable, I believe that you would do much better buying in other locations at that particular price point. Then in Melbourne would be Officer South, located about an hour and a half southeast of the Melbourne CBD. The median price is over $900,000 for a house here. However, the vacancy rate is over 5%. That is way too high, and it would show me that the odds are you would struggle to get your property rented, which would play havoc with your cash flow. Plus, the average hold period for people who buy houses in this suburb is only just over 4 years. That's too short. You want to be buying in areas where people are moving in, as I said, to buy and live longer term. 4 years is just not a long enough period for me to be comfortable around the long-term capital growth prospects of this suburb. So now let's stop picking on Melbourne and move to our biggest capital city, Sydney. This is a market where a lot of people think property prices just keep rising. However, there are some suburbs that I believe have a higher level of risk associated with them, and I would avoid them, starting with North Kellyville. The median price is 1.8 million for a house. Really high. You can do a lot better from a price point perspective, and that will also give you a much better rental return as well, which is going to be important if you want to build a portfolio. But what really concerns me here is once again the high vacancy rate. This is a suburb where the odds are you'd struggle to find a tenant quickly, which again will play havoc with your cash flow. Also, this suburb has a high percentage of building approvals at over 2%. We want to see building approvals at 1% or less. So that means that this is a suburb where they're actively trying to increase supply. And anytime there's an excess of supply in the market, that will be the enemy of capital growth. What that means is that I don't see a lot of growth in this suburb going forwards for the foreseeable future. When we look at the auction clearance rate for this particular suburb, it's at less than 50%, when Sydney as an average is sitting at the high 60% and even low 70%. So again, it just shows that this is a market that is probably not going to see a lot of growth in the short to medium term. Then we move to the nearby Box Hill, a suburb with a median price of just under 1.4 million, located just over an hour to the north of the CBD. What bothers me here is two particular indicators. Number one, the number of building approvals. It's at 6%, which is extremely high. So this is a market where again they're actively trying to increase supply, which, as I said earlier on, is the enemy of capital growth. So you're probably not going to see a lot of price growth in this particular suburb based on the data. And then the vacancy rate is extremely high at over 7.4%. That means you will almost certainly struggle to find a tenant in this market. Your rental returns will be really poor. Combine that with poor capital growth, this is a suburb that I would be avoiding in 2025. Then if we move north to Queensland, let's look at the Loia Valley, located between Brisbane and Toowoomba, a market where property prices are rising right now and the vacancy rate is quite low. So why would I avoid it? Simple. The Loia Valley is highly prone to floods. As you can see here, it's flooded twice in a 14-month period and has a long track record of being frequently affected by floods. Similar to like Lismore in New South Wales, markets where there's a high risk of flood damage or bushfire damage, I'm not going anywhere near them. These are the kinds of markets that even if property prices rise, I personally would never be able to sleep at night because there's such a high chance that you could be affected adversely by Mother Nature. Moving up north to Queensland, we come to the city of Emerald. Lovely name, but a market that I would be certainly wanting to stay away from. Why? Well, first of all, if we look at what's happened to property prices over the last, say, 25 years, they've risen a total of 100 grand in 25 years, or an average of $4,000 a year. A lot of that growth has been concentrated over the last few years, and although I am not like others who say that, oh, if a market has not grown in the past, it's not going to grow in the future, that makes no sense. Look at what happened in Perth. It was flat for 10, 11 years and then took off. So I'm not saying that just because it hasn't grown in the past does not mean it won't grow in the future. What I am saying though is, what has changed for this market to grow in value? At the moment, people are buying because it's cheap, but I'm not seeing a huge change in the economic diversity. This is still an area heavily reliant on mining, although I think property prices might rise in the next 2 to 3 years based on short-term demand, simply the fact that it's cheap compared to so many other areas, especially other markets in central and north Queensland. We might see a short-term uplift similar to what I expect will happen in Darwin, but long-term, this is not a market that I believe is going to give you consistent capital growth, consistent rental income, and a property that you can rely on to build wealth for your future. The final two areas we're going to look at are both in WA. Number one, Canington. Median price point around $658,000, and the market that's really exploded in the last 12 months, prices have risen over 16%. So then why would I say you should avoid this particular market? Especially when it's located only 21 minutes southeast of the Perth CBD. Two reasons. Number one, the percentage of renter to owner is just too high at 57%. That means you don't have enough owner occupiers moving into this market right now, which will certainly compromise on capital growth. And secondly, when you look at the number of building approvals, it's at 4.97%, so nearly 5%. Like I said earlier, we want to look at building approvals being 1% or lower. So that means this is a market where there's lots of supply coming on, which again can compromise your capital growth. And finally, we come to Midland, an area located 30 minutes northeast of the Perth CBD. Two reasons why this is a market I would be avoiding. Number one, too many tenants versus owner-occupier. The ratio of tenant to owner-occupier is a majority tenants at 57%. We want to see that ratio flip. We want to be buying in markets that have a majority of owner-occupiers, because that's what's going to give you long-term capital growth. So a market where there's a majority of tenants, unlikely to give you consistent capital growth going forwards. And secondly, the low socioeconomic status of this area, unless that changes, indicates that capital growth going forwards isn't going to be as good as other areas. As you can see, there's more to buying a property in an area than just saying, oh, prices are likely to rise, or maybe you know the area, or you like the area. You've got to look at the key data points. And as I said earlier on, if you want help to find the best areas to invest in, check out the link in the description below to get totally for free the audio version and digital version of my book. But knowing which areas to avoid is just one part of the puzzle, because according to one of Australia's major research firms, things are about to get a lot tougher for the Australian property market. So before you buy your next investment property, check out this video here where I talk about what they're predicting and how you can prepare for what's coming next.